80% of your losing trades probably look exactly the same. You enter a position, you feel good about it, you place your stop loss right below the recent low because that's what the textbooks told you to do. Then you watch. You wait. The market dips. It keeps dipping. It crosses that red line you drew on the chart. Your broker triggers the sell order. You take the loss. And then the market reverses 5 minutes later and rockets straight to your profit target without you. It feels personal. It feels like someone at a bank desk in London or New York is watching your specific account and laughing. You lost money on a trade that was actually right. That is the specific type of pain that makes traders quit. It makes you want to stop using stop losses entirely. But you know you can't do that because one bad run would wipe you out. So you're stuck. You are trapped in a cycle of getting wicked out, watching profits vanish, and feeling like the market is hunting you. Here is the brutal truth. The market isn't hunting you. The market doesn't even know you exist. The problem is that your stop-loss strategy is built on fear, bad math, and a fundamental misunderstanding of how liquidity works. I want to show you why the safety net you trust is actually the thing cutting your throat. Most traders determine their stop-loss based entirely on their own anxiety. I call this the wallet stop. It ignores the chart completely. I knew a trader named Michael. He was a graphic designer by day, trying to fund a wedding by trading the euro-dollar pair at night. Michael had a $5,000 account. He had read somewhere that you should never risk more than 1% of your account. That's $50. So every time Michael opened a trade, he calculated exactly where $50 of loss would be, and he put his stop loss there. It didn't matter if the market volatility was high. It didn't matter if there was a major support level 10 pips lower. Michael felt safe because he knew exactly how much he would lose. Here is what happened to Michael. In 3 months, he took 40 trades. He was right about the direction on 25 of them, but he lost money on 32 of them. Why? Because the market does not care about Michael's wedding budget. The market moves based on volatility and liquidity. If the average daily range of an asset is 100 pips and you place a 20-pip stop because that's all your wallet can handle, you are essentially gambling on noise. You are asking a hurricane to stay inside a teacup. I've found that this is the first major shift you have to make. You cannot dictate terms to the market. If your technical analysis says the invalidation point is 50 pips away, but your account size only allows for a 20-pip stop, you don't tighten the stop, you reduce the position size. Michael eventually fixed this. He stopped thinking about the dollar amount first. He started finding the structural level where the trade was actually wrong, not just expensive, but wrong, and sized his position to fit that distance. His win rate went up immediately. He stopped getting shaken out by random noise. He realized that a wider stop with smaller size is infinitely better than a tight stop with big size. There's a piece of advice that floats around every trading forum and Discord server. It sounds responsible. It sounds like smart risk management. People say, move your stop to break even as soon as possible to protect your capital. This advice destroys more accounts than bad entries ever could. Let's talk about Sarah. Sarah was a former emergency room nurse. She was used to high pressure, but she hated losing money. She viewed every dollar lost as a failure. She started trading gold. Gold is volatile. It moves fast. Sarah would enter a trade, the price would jump up $200 in profit, her heart would race. She would immediately drag her stop loss to her entry price. She would tell herself, now I have a risk-free trade. She felt relief. But trading isn't about relief, it's about probability. I watched Sarah do this for 6 months. She would enter perfectly, gold would retrace because gold always retraces, and tap her entry point. She would get stopped out for 0 profit, then gold would fly 2,000 points in her direction. She didn't lose money on the trade, but she lost the opportunity cost. She paid the spread, she paid the commission, she spent the mental energy, and she got nothing. Moving your stop to break even is an act of fear. You're telling the market that you don't trust your original analysis. Here's what I've noticed about professional traders. They're comfortable being in the red. They know that price rarely moves in a straight line. It breathes, it expands and contracts. When you move your stop to break even too early, you're suffocating the trade. You're not giving it room to breathe. If you are entering a trade, you must accept the risk of the full stop loss before you click the button. If you can't accept the loss, don't take the trade. But don't strangle a good trade just because you want to feel safe. Sarah eventually learned to leave her stop alone until the market created a new structural low. She went from having a 90% break-even rate to having a 40% win rate with massive winners. That is a profitable trade-off. If you put your stop loss exactly 1 pip below the double bottom or the obvious support level, you are basically holding up a neon sign that says, "Please take my money." Institutional algorithms are programmed to seek liquidity. They need to buy a lot of shares or contracts. To buy a lot, they need a lot of sellers. Where are the sellers? They are right below the obvious support level where thousands of retail traders have placed their stop-loss sell orders. Let me tell you about Kenji. Kenji was a math whiz. He loved precise numbers. If the support level was at 150.00, Kenji put his stop at 149.99. It was logical. It was precise. And Kenji got wrecked over and over again. He would show me his charts. "Look," he would say, "it broke support by 2 pips, hit my stop, and then rallied." He thought the market was rigged. He thought the broker was cheating him. The market wasn't rigged. It was just efficient. The price dipped below support to grab all the sell orders, which creates liquidity for the big players to buy, and once their orders were filled, the price went up. This is often called a stop hunt, but it's really just the market doing its job. I found that you have to be smarter than the obvious level. You have to place your stop where the pain is too great for the market to go unless the trend is truly over. You need to add a buffer. If the support is at 150, put your stop at 149.80. Give it room to wick. Let the market test the level, fail, and reverse. Kenji started adding the average true range to his spot placement. He stopped getting wicked out by the noise. He stopped trying to be precise and started trying to be safe. There is a fantasy that you can risk $10 to make $1,000. Social media loves this. They show you trades with a 1 to 50 risk-to-reward ratio. They tell you that you only need a 5-pip stop loss to catch the entire trend. This is technically possible. It is also practically impossible for human psychology to handle. Meet David. David was a corporate lawyer. He was smart, aggressive, and used to winning. He wanted efficiency. He didn't want to risk $100 to make $200. That was boring. He wanted the home run. So David started scalping the NASDAQ with tiny stops, 10 points, sometimes 5 points. He was trying to catch the exact bottom of the move. Here is the reality of that strategy. To get a 1 to 20 risk-to-reward ratio, you're going to lose a lot. You might lose 15 times in a row. David would lose and lose and lose. By the time the big move finally happened, he was so emotionally exhausted and so beaten down that he either missed the entry or took profits way too early just to feel a win. He had a theoretical edge, but he had a psychological disadvantage. I found that a wider stop loss often leads to more profit, even if the risk-to-reward ratio looks worse on paper. Why? Because you actually stay in the trade. A strategy with a 40% win rate and a 2-to-1 reward is infinitely easier to trade than a strategy with a 5% win rate and a 20-to-1 reward. Your brain likes dopamine. It likes being right occasionally. When you use tiny stops to try and be a sniper, you are setting yourself up for a mental breakdown. David had to lower his expectations. He widened his stops. His risk to reward dropped to 1 to 2 or 1 to 3, but his win rate jumped to 50%. He stopped feeling like a failure every day. He started making money. There was a dangerous idea that expert traders don't use hard stops. They use mental stops. They say, "I'll get out if it closes below this level." Let me be very clear about this. Unless you have the emotional control of a monk and the reaction speed of a fighter pilot, mental stops are suicide. I remember a trader named Elena. She had been trading for 2 years. She was profitable. She felt confident. She decided hard stops were for beginners because sometimes the market wicked her out. So she switched to mental stops. One afternoon, the Federal Reserve released minutes from a meeting. It wasn't even a major rate decision, just minutes. But the algorithm didn't like a specific sentence. The S&P 500 dropped 40 points in 12 seconds. Elena saw the price hit her mental stop. She froze. She thought, "It's moving too fast. It will bounce." It didn't bounce. It dropped another 20 points. Now she was down double her normal risk. She thought, "I can't exit now. It's too big a loss. I have to wait for a pullback." The pullback never came. She wiped out 4 months of profit in 4 minutes. I found that the hard stop is not just about money. It is about outsourcing your discipline. When money is on the line, your IQ drops. You become a scared animal. You cannot trust yourself to make the rational decision when you are staring at a massive red candle. You need the machine to do it for you. You need to pre-commit to the loss. Elena went back to hard stops the next day, but she made a change. She put her hard stop at the catastrophe level, the point where the trade is absolutely dead, and she used alerts for her invalidation level. If the alert went off, she would assess. If the hard stop got hit, she was out. No questions asked. Here is one concept almost nobody talks about. Sometimes the price doesn't hit your stop, and it doesn't hit your target. It just does nothing. It goes sideways. It chops. This is dangerous because capital has a cost, not just interest, but mental energy. I use what I call a time stop. If I enter a trade expecting a move, and that move hasn't happened within a specific time frame, 4 hours, 2 days, whatever fits your style, I kill the trade. Why? Because my thesis was based on momentum. If the momentum isn't there, the thesis is invalid, even if the price level hasn't broken. Imagine you're waiting for a bus. The schedule says it comes at 2 o'clock. It is now 4 o'clock. The bus hasn't crashed, hit your stop loss, but it also clearly isn't coming on schedule. Do you keep sitting there, or do you get up and walk? Stale trades are where bad decisions happen. You get bored, you start tweaking things, you start hoping. Get out of dead trades, free up your mental capital. I found that clearing the deck of stagnant positions gives you the clarity to find the next winner. So where does this leave us? You need to stop looking at your stop loss as a punishment. It isn't a failure. It is the cost of doing business. It is the insurance premium you pay to have the opportunity to make money. The traders who make it, the Michaels, the Sarahs, the Davids who figured it out, they all stopped trying to be perfect. They stopped trying to predict the exact turning point. They accepted that the market is messy. They widened their stops to account for that mess. They lowered their position size so the wider stops didn't hurt their wallet. They stopped moving to break even out of fear. And most importantly, they forgave themselves for losing. Here's your task. It's simple, but it will feel uncomfortable. Tomorrow, when you look for a trade, I want you to find your normal stop-loss level, the one you would usually place. Then, I want you to double the distance. If you usually put it 10 pips away, put it 20 pips away. But, and this is the non-negotiable part, you have to cut your position size in half. Same monetary risk, double the breathing room. Watch what happens to your psychology. Watch how much calmer you feel when the price dips against you. Watch how many trades that used to stop you out now turn into winners. Stop trying to avoid losses. You can't. Start managing them like a professional.